A really important concept for any business is the total length of time in between receiving money from customers from the sale of products or services and paying for the costs incurred in the provision of those products or services. This cycle is called the operating cycle or the cash conversion cycle. And it's really important because the more quickly a business can do this, the more it can do with the money that it receives, whether that be paying dividends to shareholders or investing the money within the business to try to improve profitability or efficiency. The more quickly a business can convert its current assets into cash, the more likely it is to succeed. So let's take a look at an example of the operating cycle in a retail business. So here we've set receivables days to 15 days, payables days to 5 days. We're going to buy some inventory, sell it a while later, and work out how to calculate the total length of time. For the purposes of the example, we're just going to keep the gross profit margin at 0%. So on day one, we're going to buy £100,000 worth of inventory. We reset purchases to 0 and restart. We should see that on day 6, 5 days after buying it, we make the payment for the inventory. So if we want to sell that inventory on day 11, 10 days after buying it, let's set revenue to 100,000, gross profit margin is 0, and we can see that we sell the inventory and now there's a receivables balance. And what we should find 15 days later, so on day 26, we should receive the cash from customers. So in total, we've had to wait 15 days for the receivables days. We've kept the inventory in stock for 10 days, so it's 25 days, but we've got to take off the 5 days that we waited before paying the supplier, so 20 days in total for the operating cycle.